Hello. Welcome to Tuesdays with Lloyds. I'm Mark Rector, U.S. Project Manager with Lloyds, and it's my pleasure to introduce this session on the U.S. construction market today. Although this is our final Tuesday with Lloyds sessions for the year, we're going to continue the series in 2021 with ongoing Tuesday sessions showcasing individual underwriting syndicates, specialist classes of business, and innovative risk solutions on offer in the Lloyds market. Now, let me introduce the panel for today. Raj Brar is a senior construction underwriter at Axis Capital, specializing in CAR and EAR projects, operational power, and contractors, plant, and equipment insurance classes. Raj began his career on the broker side with Willis and Dashwood before becoming an underwriter for engineering and construction risks at Catlin, ProSite Specialty, Chubb, Britt, and now Axis. John Shaw is a construction and engineering underwriter at Canopius. Before that, John was the underwriting manager for QBE Australia in Sydney, responsible for the management and development of the construction portfolio in Northern Australia. John is a fellow of the Chartered Insurance Institute. And our final panelist is Anna Woolley. She's a senior underwriter at Axis Capital, which manages Axis Syndicate 1686 in Lloyds. Anna writes international project construction business, concentrating on the power, OP&G, and mining sectors. Prior to working at Axis, Anna headed up the offshore wind team at G-Cube and has held senior underwriting positions at Zurich and C&A Hardy within the London market. Anna is a qualified mechanical engineer and an associate of the Chartered Insurance Institute. And finally, our moderator today is Stephen Tillie, Director of Property and Construction at Newman, Pearce and Partners. Stephen holds a first-class degree in mechanical engineering and is an associate of the Chartered Insurance Institute. He has a wide experience of the construction and mining sectors and has placed cover for projects located throughout the world. Now, as we go on today, please feel free to use the Q&A tool for any questions that you have for the panel. We'll try to answer as many as we can, and we left some time at the end of the session to answer your questions. We're also streaming today's session on YouTube, and we'll drop a link to that recording into the chat in case you want to share it with any of your colleagues afterwards. And finally, before we begin, please be advised that the views and opinions expressed by the panelist and moderator today are their own and do not necessarily reflect the official policies or positions of any agency, organization, employer, or company. And with that, I'll hand it off to Stephen and the panel. Thank you.
Well, thank you very much indeed, Mark, for such a kind introduction. And may I start by saying it's a tremendous pleasure to be on the call with so many great underwriters within Lloyds in the construction engineering class. And I'm very grateful to Lloyds and the Lloyds US representatives for kindly allowing us this platform to talk about what we do as a specialty class in the marketplace, and of course, hopefully to share that with some folks trading in the market where we might bring them some insight into the class and how Lloyds and the market participants can support their business and help their clients. So as I say, delighted to be on with some really senior underwriters from the market, and I hope it's an informative session. What we'll do is we'll go through some questions, and we'll look forward to seeing some inquiries coming through on the Q&A tool, and we might pause as we go through to pick up on some of those comments. But I'll kick off just now with the first question, and we'll see how we go. So I hope you find it informative and interesting. So the first question that I'd like to put to our underwriting panelists is, what are the biggest challenges that you each see in the US construction marketplace for insurance, and how can you achieve the best solutions for your clients? So if I could ask that first question to Anna, what are the biggest challenges that you see in the US construction market, and how can you achieve the best solutions for your clients, please?
Hi, Stephen. Yeah, no problem. It's certainly an interesting time at the moment, both in the US and globally for the construction engineering market. Obviously, we've got everything that's going on with COVID. We can't ignore that. We've got delays in construction projects, which is combined with a withdrawal of capacity from the construction market. It's been a challenge, I think, over the last 18 months, and we're seeing a correctional shift in the market in terms of terms and conditions and pricing. So we've got that going on sort of parallel to everything we've got going on with COVID. We're still seeing a good flow of business from the US. There's still projects going ahead, and it's still coming to London. We're just seeing a bit of a delay in the time between when we quote it and when we initially see it to financial close. And I don't think that's unexpected with what's going on. Specifically in the US, I don't think you can ignore the cat exposure. That's obviously a big one. The Gulf wind and the earthquake. Construction is especially susceptible to that just because of the gradual build-up in values that we have, and the offsite storage and the exposure that we have, the build-up during the construction period. So that's particularly challenging. We've definitely seen a downturn in those petrochemical projects around the Gulf just because of the oil price, but we're still seeing big LNG ports and production facilities around the Gulf. So yeah, capacity is an issue, and what the market is willing to offer. But in terms of coming up with solutions, I've always found the Lloyds market is an innovative market. It tends to think outside the box. The benefit, I think, in coming to Lloyds is that we write international business. So all we do all day, every day, is construction business, whether you like it or not. Hopefully you like it, which is why we work in it. So we'll see a power project every month, and perhaps a more generalist insurer, a property insurer, will only see a power project twice a year. So we really keep up to date with changes in technology. We have quite close links with manufacturers, and they quite often come and update us on their technology. So we can always, I think, provide the best solution for the client because we understand the technology and the processes and the market, having seen it probably elsewhere in the world. It's quite hard to look at a market in isolation, because for us, we look at it as a global market. What happens in one country impacts what happens in another.
So is it fair to say that, you know, Lloyd's is a great place to come if you're looking for perhaps a leading line or a market that's familiar with the latest technology that, you know, might be new for the specific location or indeed the client, but there's a comfort there that you've seen it before, perhaps?
Yeah, definitely. And I think even if we haven't seen it before, it doesn't faze us. And I think what the Lloyd's mentality is that no risk is uninsurable. It's just finding the right terms and the right coverage to apply to it to make us comfortable. So we'll look at everything, but it's just a case of finding what is the applicable coverage. But yeah, definitely.
And I think traditionally Lloyd's has been a great home for US business. I think some 40% of Lloyd's gross written premium is from US domiciled clients. In 2018 is about just shy of $19 billion. And so there's great success happening there. And if I could move that question now, thank you, Anna, to John. What are you seeing as some of the biggest challenges in your recent experience for the US construction clients, and how are you finding you're able to support them and come up with solutions?
As you said, the main bulk of Lloyd's business is from the US. So whatever challenges there are, they're certainly not insurmountable. We deal with projects across all states pretty much every day. We are the specialists in construction. Therefore, as Anna said, we see these things far more times than anyone who is a multi-class underwriter ever would. So I think the big challenges are the dynamics of the big traditional insurers that you have incumbent in any territory, and that's no different from the US, and their deployment of capacity compared to looking at the Lloyd's model, where we are solutions driven. We try to find the best options for the client. But within that, we have a tendency to require that bit more information, that bit more analysis. We want to dig deeper into the risk. And while I think there's a tendency to think of that as a negative, there really shouldn't be that negative connotation to us wanting to know more about any particular risk. But one, we're interested in ultimately what is happening. We have a pretty good understanding of whatever it is that's being presented to us, and that desire to want to know more enables us to give us a more effective solution to the client. Ultimately, when you're talking about construction, it's not just about price. It's about the level of coverage that is being offered, the need for certain levels of coverage. And within the Lloyd's environment, we're able to tailor that far more easily than you can from a large domestic or any other carrier that doesn't specialize. I think the main challenge, and there's no getting away from this, is the cap and the increased cap at the moment. But again, it's not insurmountable. We place and deal with cap risks on a weekly basis. So it's one of those things, and it's factored in, but it's not that much of an issue. And traditionally, that's why people come to Lloyd's.
I think excellent points there, and it's worth noting that for the physical damage side of the market, which is typically what the expert underwriters on this panel are concerned with trading in day to day, generally speaking, it's a subscription market. So it's a complementary solution between Lloyd's and domestic carriers. And you know, one of the things John picked up on there, which I'd like to pick up on, and if I could then move to Raj for his thoughts. One of the viewers has asked, give an example of a coverage that Lloyd's can provide that you might not see from a domestic carrier. So Raj, if I could ask you perhaps to pick up on that with your experience, noting obviously you do both the project insurances, but you also do annual specialist programs. Could you give us some thoughts on specific coverages that Lloyd's could offer that we might not see in the domestic marketplace?
Thanks, Stephen. Yeah, that's a very good question, and I'll try and come at my answers a bit more through the delegated underwriting space, where I spend more of my time than the open market specialists on the panel. And quite an easy one for that, if you have a delegate authority for a US carrier writing for US insureds, but you may get some overseas exposure, that's something Lloyd's can handle pretty well because we write a global book. So we see that quite often with our cover holders in various territories. They'll get a contractor who's doing a lot of work domestically, but they get a contract overseas, or there's some overseas exposure. That is something Lloyd's can handle very easily. And that is where you see some domestic markets which are very good within their own space and where they're allowed to write, but they don't have that flexibility to get something that comes out of the box. And that's where I think Lloyd's can really sort of stand out for you.
I think that's a fantastic point, because you've got the Lloyd's obviously has the excess and surplus capability into the States, but is licensed in many cases around the world, if not on a direct basis, often on a reinsurance basis. And so, you know, that international scope that the underwriters have on the panel is extremely useful. And also Lloyd's brokers, who have a network of local correspondents, and through that amazing Lloyd's network, if you do have a US customer that's doing work overseas, I think, or has assets overseas, I think it's an excellent point, and one I've seen myself from working with customers in the past. So thank you. I'll move on to the next question then. The next question is, what are some of the major trends in terms of losses or risk issues that seem to be driving the market behavior? So what are we seeing in terms of major trends of losses or risk issues that are driving market behavior? And actually, I'll stick with Raj if I can on this. Raj, what are you seeing in terms of trends or losses that seem to be moving the market at the moment?
Well, I think the first one would be fire losses. There's been nearly 30 large fires for US residential projects this year, all over $1 million, and at least half of those were in excess of 10 million. I mean, if that's written into anybody's account, that's going to hurt your numbers. So, and some of that is often driven, and you know, that may have been driven by some of the sort of social unrest, but it does show that it shows how big, while we worry about all these other coverages, fire is something that should be at the forefront of any underwriter's thoughts. And that's very closely followed by water damage. We call that the silent killer. It has just built up over the years as just a real attritional exposure, millions of dollars of losses of water damage from burst pipes and incorrect input of infrastructure into a building. They're the two main ones that are driving losses I can sort of see from my perspective. And then sort of the third category is down to cat. There's been increased cat exposure in the last few years, and all those three factors are going to affect your underwriting results.
So there are a range of factors there, and I think it's a point that was maybe touched upon earlier, that it's a global marketplace, and whilst the US is a massive focal point for Lloyds, and indeed it is for everyone on this panel. There will be losses that are happening across the wider marketplace that impact local market conditions. And that was one of the questions that actually just came through from someone watching, was, are we seeing hard and soft market conditions across the states? And I wouldn't necessarily say that I've seen that. I think it would tend to be depending on what those critical exposures are, by type of project, by the assets, by their proximity to cat exposure, and things of that nature, rather than you change your postcode and you're automatically in a different market environment. I'm not sure that that is the case. I think it's more the fundamentals that seem to drive the market. So thank you for that, Raj. That was extremely helpful. If I could pass to John, please. John, are you seeing anything in addition to what Raj has highlighted that seems to be driving the market?
I think in reality, Raj ticked both the boxes there. That fire may take the headlines. There's no getting away from it. Something's on fire, you notice it if you're in the local environment, and it makes the headlines. What water damage, though, is the issue that's creeping up. It's becoming far more than an attritional loss. It's really starting to deliver some major losses within the commercial and residential sector. And at the moment, there has been no consensus and cross-industry groups coming together to really reach some sort of agreement on the best course of action. While I anticipate that will come to the fore and will be resolved in the next few years, at the moment, from an underwriting perspective, we're left with continued increase in losses. Those losses only increase as you go up in height, and obviously within the US in particular, there is a desire to go high in terms of your buildings, and really that has a huge impact on your underwriting results. I suppose the other element that you touched on is the global nature of insurance, and the fact that we have billion-dollar losses elsewhere in the world, and ultimately that's going to trickle down into the domestic markets. The fact that a dam collapses in Latin America is still fundamentally going to impact a full wall construction in Idaho. That's just the nature of the beast, sadly.
But I think, with that very open and transparent commentary, John, it's still fair to say that if clients and customers and brokers engage early with the specialist underwriters and they're willing to help them understand their approach to risk management, understand their contracting positions and things of this nature as to risk allocation and responsibility, that they will see differential treatment through the underwriting market, because the underwriters understand what good looks like versus what the standard is. So I think, would you say it's fair that customers and clients can still achieve better than peer group terms if they're willing to engage properly with the marketplace and if they've got some guidance perhaps from an advisor?
Definitely. It comes back to my previous point that the more information, we want more information. We want to delve into the project that's presented to us. And by presenting a far more open book, we are able to see how you differentiate yourself from your neighbour. And ultimately, that's going to result in a different offering coming forward. And as I stated before, it's not all about price. It's about what we can do to present the correct solution for the project that you are building at that time, and not the one that you think you need or other sort of circumstances around it. It isn't just a stack it here and there and providing the same sort of coverage. It's all about a tailored solution, and that's what Lloyds does.
Thank you very much. Anna, is there anything you'd like to add to the commentary from the gents there?
No, I think they've touched on the kind of the two sort of big areas that we're seeing at the moment driving claims. In terms of trends in the market, we're seeing obviously because of construction delays caused by COVID and supply chain issues and labour force issues, we're seeing a lot of extensions in existing projects, and because of the state of the market, the construction market at the moment, with the reduction in capacity and markets withdrawing, we're quite often being asked to come on midterm to a risk that we're not already on. So we're seeing replacement lines for pre-existing construction projects quite frequently, and that's something we can certainly look at, and as John touched on, the more information we have, the more likely we are to sort of come on and help that client. And I think the last thing we want is to leave a client without an insurance backing. But yeah, we need the right information, and we need sort of communication with the client in order to provide that. But that's definitely a trend that's come along in the last 12 months.
Yeah. And I think that's it. It's also a very non-standard position, because construction being a typically non-renewing class, long-term, long-tail business, nobody really expects to have that issue, but projects do to get delayed, and we're in exceptional circumstances right now. And I think it's almost that customers and brokers have to be prepared to represent as if it were a brand new project, and note that that underwriter hasn't had the benefit of learning about the project from the start. So we have to try and play catch up in a short space of time. And I think it's a very relevant comment as to one of the current challenges and trends in the market. Thank you. I've had a question from the viewers. Are the air modeling system results accepted compared to RMS? So we've been talking about CAT. Raj, do you have any comments on that? I mean, I know sometimes you maybe rate differently. You've got different models and you choose which one you prefer, but do you see much difference?
They are different. It really is more driven by which company you work for, which system they bought into as their standard. So it does vary by company in London, because some use RMS and some use AIR. Sorry. It will be different depending which company you're presenting those to. And there are differences. I was at Brit where they moved from RMS to AIR, and certain risks suddenly went from being within appetite to outside of appetite without any major changes, just difference in the outputs of the two models. Because at the end of the day, they are modeling systems. They're not perfect to reflect the real world, but they're the best proxy we have.
Sure. And it's just one component in your underwriting toolkit. Not perhaps the most important. The most important is probably the experience of the underwriter and the quality of the submission. So that's brilliant. And I think that just also highlights why it's so important to work in a subscription marketplace, because the Lloyds marketplace allows you to take a balance of views and find out who has appetite for your risk, and just and find the best home. And the next question from someone watching along is neatly segues into what we already had. So thank you, Spencer McCalla. Comment please on appetite regarding types of construction. So our question is actually, what are the sweet spots for Lloyds regards US construction business? So John, if you could please kick us off. US construction, what's the key stuff that you want to see? What kind of risks and accounts would you like to see come to you in London?
I think from a Lloyd's perspective, there are opportunities across all sectors. We are specialists within construction, but there's a myriad of underwriting occupancies within that. We have a wealth of knowledge across all these different disciplines, and although I myself might be a specialist in X, Anna might be in Y, you're able to get someone to lead that program who knows about what it is you're doing. I don't think we have a particular sweet spot for that very reason. We have grown as an entity from that position of underwriting the weird and the wonderful, and I don't think we've really moved too far away from that, and that's hence the CAT always comes into Lloyd's, because it is something that the domestic carriers would always struggle with. I think looking specifically at the US infrastructure spending has to increase. It's decreased year on year since I think 2010. Looking at the recent presidential elections, there's been some inference coming out that there'll be a $2 trillion green spend. There'll be transport infrastructure spend. All of this feeds into Lloyd's very neatly. But ultimately, this has been said before from all presidential candidates and past presidents. But with every presidential term that goes by, that the need to rectify the issues with for the infrastructure within the US become far more prevalent, and it's something that we're probably at the tipping point now where that spending needs to occur, and that's what we're here for. We're here to assist when the spending does come, because when it comes, it's got to come thick and fast, and I think people will start to struggle in terms of capacity, and we will be able to step into the breach.
Very good points made there. I think also on types of infrastructure and perhaps the mechanisms for financing in the longer term, that infrastructure development, the Lloyd's market, the London market, and of course the domestic market is a complementary proposition, is well versed in developing solutions that reflect the interests of multiple groups of stakeholders. So whether that's a government sponsor, a local authority perhaps, or state, federal level funding, right the way through the chain to the subcontractors, and understanding what the product offering can do to protect the risk allocations and what each of those parties delivering the project is taking on. So whether it's on a standard US form or whether it's on a customized project finance form, I certainly think, in my experience, I've seen Lloyds be a great supporter and driver of leading the insurance proposition for those kinds of developments. And of course, very familiar with that kind of development, if not just in the States, across the wider world. Anna, if I could move to you next to please answer that question. Sweet spots for Lloyds regards to the US. Someone asked me about Woodframe. I know it's a challenged occupancy, but what do you see? What's your key focus coming from the United States into Lloyds?
Personally, where I think we can add value is on the types of projects which are a bit out of the normal. So sort of more challenging engineering projects. I think that's where we can kind of come in and use our experience and utilize that. And like you say, become perhaps a complementary lead with a domestic market follow, or vice versa. We're seeing, particularly the US is quite often at the forefront of technology advances. So we're seeing a lot of interesting projects coming out of that, especially in terms of on the greener side. So, green hydrogen production and burning of that in turbines. And it's at the forefront of what they're doing, and it's really interesting stuff, but it's perhaps something that perhaps a generalist insurer might look at and say, we're not sure what to do with that. And that's, I think, where we can add our value, is it doesn't scare us, those kind of projects. In terms of timber frame, the market has been burnt, excuse the pun, but there's been some substantial losses and capacity has been withdrawn. We do look at it, but at quite a restricted line size. So it's something we consider, but it's got to be the right contractor, it's got to be the right project, it's got to be the right protocols, and we do look at it quite closely. And as we've touched on earlier, we need a lot of information and a lot of comfort around that, just because of the risk.
Yeah. So on the frame piece, it's a question of really risk quality, risk sharing with the customer, and a really good piece of engagement. It's not a commoditized class within the construction market. It's a very challenging class, although we might not see the largest of values per risk. It's a challenging class, and it needs special treatment. So, but the door is open, I think it's fair to say. If not wide open, slightly ajar, and you have to knock on it first before you're allowed through. But
you've got to knock and do a special handshake, but we'll let you in.
Yes, understood. Thank you very much. Raj, with your particular focus, what are you seeing on the delegated side that you're managing? Is there a suite of business that you like to see come through that you think, I'm set up perfectly for that? You touched upon cross-territory exposures earlier on.
The main thing we look for, and this is on our global book, is some sort of unique selling point. So what we'd be looking for is a potential portfolio. And so how would that look to us? Is that something I cannot access here from London? Then it makes the MGA worthwhile going through them. Do they have access to clients that I don't have access to? Do they have historical track record of profitable business? Is these type of things we want to hear, which I am not able to access business by any other means by going through a partner MGA. We've got to really justify, when you give underwriting authority to another entity, it has to really tick all the boxes. But if there's a compelling story there, like a track record or access to profitable business, then that's what we want to hear, and that's what we're happy working on. Yeah,
it makes a lot of sense. And so it's someone that you think, they're possibly doing a better job than I could do myself unless I was actually physically there, and they're a great partner for you.
Yeah, they're on the ground. They know these clients very well. They've got statistics, etc., and knowledge to back that up. Then they're the ones we're comfortable with underwriting on our behalf.
Brilliant. Excellent. Thank you. I've got another question that's come in here. Do we have concerns of projects in certain countries? how do you support the insured to manage their construction project risks, especially for hydrogen or lithium-ion battery-related projects with high risk management requirements? So concerns of projects in certain countries, well, I think that could be quite a long discussion. And I think this being a US panel forum, we might not get into that in great detail. I'd suffice it to say that the legal and regulatory environment in different countries makes it challenging, as do specific cat exposures and supply chain concerns. But how do we support, how does the Lloyds market, how do underwriters support insureds managing their construction project risk? So I think, John, I might ask you, we see midterm engineering surveys and indeed through the underwriting stage, oftentimes recommendations made. Do you see the risk engineering survey process as being one way in which there's a shared interest in risk management throughout the course of a project, which can be beneficial to customers?
Yeah, it's certainly not one way. I'd like to think that it is not perceived that way by any of the stakeholders, but ultimately from our perspective, it is there to provide a guide through the build. It shows us, it allows an objective view, which, it doesn't matter what you're doing. Sometimes you can get bogged down in something, and an extra pair of eyes can really help. And that doesn't change whether it's your own personal day-to-day life or a multi-million-dollar project. And these specialists who go in are able to offer that insight and offer that view. And a lot of the time, I think the recommendations that they make coming out the back of that really enable the project to, one, be delivered on time. And okay, we don't have the control of the budget, but ultimately we want the same thing as the client, which is on time and on budget. And I think that the ability to share knowledge coming both ways can really, really be beneficial. I've sat around the table a number of construction sites when these meetings are going ahead, and it's the throwaway comments sometimes that can really shed light on something. And the fact that these engineers or whoever it is have seen that maybe elsewhere globally, seen some of the issues that might be just around the corner, and can just add some insight. And ultimately, I think it's a great tool that we've got, and something that should be considered as such, and a real shared resource.
I completely echo that, John. Having seen it in action many times on site visits, and it once folks understand, the local broker, because obviously being a London-based broker here at Newman Pearce, we're trading with retail and wholesale brokers in the States. They're our customer, they're our client, but we also always understand who the end purchaser is. There can be a sense of, oh, here comes the leading insurer from Lloyds, they're coming to check up on us. It's not that. Everyone does want the same thing, a successful project completion. You mentioned very clearly time, quality, cost. Fantastic. And it's that ability to share experience in a collaborative and supportive way. And I think hopefully that answers the question of the viewer. That there was a follow-up to that, which said, is there a particular third-party inspection company that Lloyds have a comfort level with, or possibly a list? From a broker's perspective, I'd say it tends to be underwriting company specific. It's syndicate specific, and it will be project specific, depending on the type of project we're talking about. So I don't think we want to necessarily take that too much further, other than it will depend on the type of the project and indeed the underwriter, whether they've got in-house engineers or they choose to bring in a third-party specialist. Thank you very much, John. I will move on to our next question, some of which we've touched upon quite handily, but what are the key attributes of Lloyds that make it such an appealing place for US clients? Raj, if I could ask you to kick us off on that. What do you think is it about Lloyds that makes it so appealing to US clients?
Well, I think the one thing is your accessing market here. We work on a subscription basis, so it just brings a much more collaborative approach. So when the loss comes in, we're all sharing the loss, but also just from that, it's just a lot more collaborative. So there are working groups, because we're all sharing in the same losses. If there's some problems, well, we can all get together and underwrite and discuss how best to manage them. And if that's a new risk management or procedures or codes of practice, which should then feed down to our insureds. And so we've seen these losses, we've seen these things happen in another country. We can then feed that back to them. And that's just it's not just about just sharing the losses, it's about that pool of knowledge you can access here does get fed back down to the insured. And I think that's one key thing for that. And also, I think just the fact you can get bespoke wordings. All the London underwriters are trained to sit there and look at a risk where the broker could change the wording, or we could look at different coverages sort of on the fly, rather than looking at just a bespoke US form, which is quite set in stone. So a client could call up Stephen and say, can you get me this coverage? He can come into London and probably within the space of a couple of hours have a chat with all three of us who are on the panel and have different ideas and different responses in terms of how you want to place the risk.
I think that's an extremely good set of points you've made, both in terms of the fact that the collaboration is a positive thing, and it's also on the forefront of developing new products or solutions for new exposures and the ability to look at custom solutions. And I completely agree, because it is a true marketplace, and the ability to write on a subscription basis means that in most cases we're going with the best available terms, and the market supports one another. So I think thank you, Raj, those are excellent points as to why US clients and customers should be thinking about Lloyds and at least try out the market and see what the alternatives are. I'll move that on to John, if I may. John, key attributes of Lloyds, further to what Raj touched upon, that you see being so appealing?
Well, firstly, I don't think you can get away from how important that subscription market is and what it really brings and the benefits it brings to us and also to the client. So I think it's worth reiterating that the subscription market is key to all our success, and it should be something that should be embraced as much as is possible. I think the other element is Lloyds understands CAT. We have been writing CAT for a long time. We have specialist teams within every syndicate whose day job is the modelling of individual CAT risk, the portfolio, managing that accumulation of values, and really it's an art form as well as a science, and being able to really control that is something that Lloyds is incredibly good at. And having worked in both the Lloyds environment and also outside in the more traditional company sector, you can really see the difference when you come into a Lloyds syndicate and how they manage their exposures for CAT and how they underwrite CAT. It's black and white in terms of how much knowledge and understanding there is there. And that's the reason why Lloyds traditionally has written so much CAT and will continue to do so. It's a real differentiator.
Brilliant, thank you. And Anna, please may I ask for your thoughts on that topic, on what is it you feel about Lloyds, what it is about this place that's currently not very occupied that makes it so appealing for US clients?
A big empty building at the moment.
A big empty building.
As Raj and John have already touched on, I mean, we can't get past the subscription market nature of business, which I think is hugely beneficial. It means the wordings are all bespoke, and we're not afraid of looking at those wordings and adapting them for the specific risk or the specific client that we see. And I think quite often the issue with sort of domestic wordings is they're set in stone and the endorsements are set in stone, and that's the product you get. Whereas we will look at each individual risk and come up with a product which fits that perfectly. And I think, as Raj mentioned, there's certain working groups in London. The London Engineering Group is at the forefront of this, and they frequently get together and work on new clauses, and they're always looking at ways of adapting the policies which the whole market signs up to. So it's never one underwriter in isolation, it's a market movement, and I think that's really beneficial.
I completely agree. And I was scribbling a few notes as I was listening to the comments there, and I just add to that, in my opinion, it's the quality of security in Lloyds. It's A-rated paper from the major rating agencies and has been for some time. There's the three-link chain of security that effectively guarantees Lloyds policies, which is more details on which are freely available at the Lloyds website. I find that the underwriters that I'm trading with as a broker have both the knowledge and the authority to be able to sign off on business, as Anna touched upon with the custom wording solutions. And the market kind of self-regulates because, as John was highlighting, and so was Raj, the subscription piece, really important. So there's almost like a peer review process as we build the capacity on any one risk. Final comment would be, in many cases, we need a quick response for customers. You know, we have an overseas broker, they need a quick response on terms and conditions. What information would I need to complete a placement? We can pick up the phone. We used to be able to go into the building. We do on, I think, 1 day a week at the moment. But in normal trading circumstances, we could build a really quick, clear picture of what's needed on an individual risk. And that, to me, is a real key thing. We can get back to you pretty quickly. So it's an efficient marketplace if at times it seems like it's stuck in the past because of the tradition and the history. But I do think it's a fantastic place, and you have to try it, and you can't ignore it. You can't ignore it. I've got a question in here from someone watching along. To the panel, do you price construction projects of new risks, i.e. prototypical or developing technologies, such as hydrogen fuel cells? Do you price those types of risks differently to traditional manufacturing facilities? And if so, why? So, John, could I start with you on that, if I may? What's the key difference in terms of your underwriting approach on some of those new technologies versus perhaps more traditional facilities?
The experience. Ultimately, if it's prototypical, we don't know what the end result is going to be. Is this even going to work? And the difficulties there are, what is presented is an idea. Is it something that has worked on a test facility that they are ramping up in size to deliver far greater output? Is that going to work when you ramp it up? For us, we have to know, we have to get the data behind that, whether it's going to work. There are going to be far more constraints on a prototypical piece of business, because ultimately we are not here to ensure whether it works or not. We're here to ensure the process of getting it to there. But fundamentally, if it wasn't going to work in the first instance, that's not our responsibility. So there are going to be, it needs to be a far more collaborative approach there than it would be for a far more traditional project. The traditional project, we'd be asking for a list of information, we'd be able to work through that, and there may be further conversations. But I think if a prototypical project is being brought to the table, it needs to be engage extremely early, and bring the underwriters into the whole process, so that come the point where you have financial close and you are looking to actually start the build, don't bring us in then, because then ultimately we're going to ask a myriad of questions that will involve digging through all that information that will have been there, and those conversations will have been had. But if we're party to them, it becomes far easier for us to overcome what is an understandable obstacle. Yeah.
And actually, I think there's a point you made there that I've found extremely relevant in the past, is that you engage early, or you talk to the underwriters over a longer period of time. Is this going to slow everything down? I think the irony is it's quite the opposite. If you're engaged early and you're just staying in touch throughout the process, you're more likely to achieve a successful financial close, even on a challenging occupancy or type of technology, irrespective of terms and conditions, because sometimes insurance is thought of as a tick box at the tail end, but it's a condition precedent to many project financings, that suitable insurance is in place to the right limit, to the right specification, and indeed to reflect the risk that the contracting parties are taking on. So I do think, particularly on those new developing technologies, the rating will be what it is, and it's, this is a generic session. We can't talk about differences for power versus new mining technology versus mid and downstream oil and gas, but early engagement helpful. So thank you, John. Thanks for that. That was just a question from someone watching along. So we've gone through a fair bit there. Finish the preset questions on a positive. What are we looking forward to in 2021? Not far away now. Anna, what are you looking forward to in 2021?
Looking forward to leaving the house, hugging people. From a business perspective, I think one of the things that we always enjoy doing, and one of the things we're good at doing in Lloyds, is face-to-face business and building those relationships, and we certainly have it with our brokers in London. But what we really like doing is getting out and meeting brokers and clients and going on risk engineering surveys and getting involved in those things. So I think it'll be really great to be able to start doing that again. There's only so much you can get across on a Zoom call.
Completely agree. Well said. Well said. Raj, what are you looking forward to next year?
Would echo that. We've definitely missed out on one of our key selling points. It's the face-to-face negotiation and the face-to-face with clients and cover holders we've missed this year. So it'll be good to rectify that and see people I haven't seen in a long time. So that's one of the main things I'm looking forward to next year.
Quite right. John, anything particular that you're looking forward to, hoping, wishing next year?
Yes, I suppose it's more in hope than expectation, but the desire to get back on the trading floor, you can't undersell how important that is. I suppose beyond that, a benign cat season would be nice, some political and economic stability, whether that be in the US, the UK or globally, would also be very beneficial to all of us. Yeah,
well said. I think I would agree with all those comments. I'm very much looking forward to traveling and meeting existing friends and making new friends and just being out and trading as nearly normal as practicable. I think the insurance industry has been remarkably resilient through this global crisis and just shows we're still here, thank goodness, and we're looking forward to seeing everyone again. It's a people business. I think that really concludes our questions there. I'm hoping that Mr. Rector will very kindly come back on and do a wrap up, and maybe we have a bit more Q&A from the audience. But from my side, suffice it to say, thank you very much indeed to Raj, to Anna, and to John for their time. They're very busy as we near the end of the year, and for their considered input and their comments, because I'm sure that it will be really helpful for those folks watching along. And of course, we've answered a few questions as we've gone. What I might do is I'll just pick up one question here that's come through on the Q&A. A good one, actually, from an anonymous attendee. Outside of the previously mentioned cat modeling developments, what technological development has improved the insurance of construction projects over the course of your career? So technology, either by underwriting or some form of process, what do you think has been the game changer in terms of the underwriting process? Raj, have you got any thoughts on that? Anything that's helped since you started?
I can't think of anything top of my head that helped since I started, but recently for surveys, the use of drones has made it a lot more easy for site access, and it means you can get pictures of the site and how the project is going a lot quicker. So I think that is very, very useful. And I think it will also be useful after a claim if it's difficult to get access to the site, or the site would be dangerous to send somebody in there and see exactly what's going to assess the damage. The use of drones there and technology could be extremely helpful in bringing these claims to a quicker close for our clients. Yeah,
I think that's a very good point, because some of these, especially on the infrastructure projects where you're long linear alignments, it's great to be able to survey that virtually, or impractical to survey some of these very long road or rail projects in person. One question that's come through here: since the onslaught of the COVID pandemic, have we seen an uptick in claims? I would have thought probably yes, but it's very subjective. John, have you seen any particular increase in claims activity, or is it more a new type of claims activity based on work cessation, things of that nature related to it?
I would say we're not quite there yet. We don't know. The proof will be in the pudding, as they say, whether there is the impact in terms of claims. Obviously, what we are seeing is a knock-on impact towards timelines and people completing projects. That puts another level of stress on any one contract, whether that be on the ground or also the contracts, the insurance contracts in terms of the extensions and things that are required. All of which have been outside of the control of the contractors and or the insureds. Whether that manifests itself in claims, from my perspective, it hasn't. I would anticipate, particularly from a US perspective, that it won't. But time will tell.
Do you think that perhaps, sometimes the cessation of work or delay in a project completing as a result of work stop orders or supply chain challenges, and just the fact that all of us are currently living usually in some way or another under a form of restriction, the knock-on effect is really that we're going to see clients having, if they haven't already, having to extend their coverage through their current expiry period. And as Anna touched upon earlier, we've seen some markets come out of the marketplace, some insurers come out of the class. Then we have clients through no fault of their own trying to extend coverage in a toughening market because of the withdrawal capacity and the recent loss experience that we've touched upon. Do you think that actually is going to be more of a factor rather than COVID specific related claims, John? Is it going to be that extension issue for some? Yeah,
possibly, and maybe not even the extension issue. I think Raj touched on the fact that there's been quite a lot of fires in the US caused by social unrest. Now, that social unrest is political, but within that, COVID is being brought into that political. It's a political football in that respect. So, yes, you could attribute a number of losses to that, but I still think it's too early to tell, because ultimately we are living under some form of restriction globally. And I think really the pain to be felt by contractors and those who are building is not quite finished yet. It's whether the economy the economies make the recovery that they hope it will, or it turns into an actual regression that no one wants to see. But I think ultimately at that point, that's when we start to see maybe an increase in claims manifesting themselves from COVID, if not directly attributed to it. But for now, every time we are released from our prisons, you start to see the bounce back. But it's whether that's sustainable and whether we can actually overcome this as a population, whether we can overcome it and then move forward as one. And at the moment, it's all very bitty. Everyone's in and out, in and out. So I still stand by the fact it's too early to tell.
Fair comment. Fair comment. I mean, one area that we've seen it very visibly here in the Lloyds marketplace is with the change in the trading environment and the underwriting room. Anna, a question for you from someone watching along. How do you see in 2021 going forward the underwriting room changing as a result of this year's transition to digital trading and virtual engagement? Do you think that's it for face-to-face for the underwriting room, or a hybrid model, or what do you think? What's going to happen?
Yeah, I think a hybrid model is definitely on the cards. I think we've all seen the benefit from working from home in terms of, more free time and flexibility, and that's actually been quite a nice release from what we were used to, which was 5 days in the office. But I don't think you can ever replace a face-to-face meeting or face-to-face contact. I think we've very quickly and very well adapted to electronic trading. And in some ways, it's a lot easier to get things done and to get things done quickly. But in some ways, things take more time and submissions take more time because we don't have a face-to-face broker. So we have to sort of trawl through all the information, which traditionally perhaps a broker would have done first and then come to us and broke face-to-face. So I think there's going to be a hybrid model. I think there'll always be a space in London where there is face-to-face contact.
Yeah, I agree. And I also hope so, because I think that the technology is wonderful for, in my opinion, dealing with the non-value add piece, or just the transfer of data, or for confirming a conversation, or for opening a conversation. But I do always think that it's that specific immediate feedback and the engagement with the underwriters where you get their thoughts, or they ask a question on the fly that, if they had to, nobody likes reading emails that often, do they? I mean, they're not very interesting, even if it is about something that's interesting, because you have to put quite a lot of work into it. You have to concentrate. Whereas I find it's much more fun talking to someone, even if it's a difficult discussion. So I do hope that it's a hybrid model. And I do think that we've made great changes in some of the electronic trading platforms. There are a few sponsored by Lloyds, and The market has more than one option, which is great. So, you know, we've seen some efficiencies there, and the marketplace is more efficient for clients, which ultimately means better value and better service. But again, sometimes the old ways are the best, if not all the time. And the face-to-face, I hope, does stay in some way, shape, or form. Raj, what do you think? Are we going to be hybrids? Are we going to be maybe a few days a week in the marketplace?
I think one of the advantages is that you can be flexible and down to the people involved. So if you do need that flexibility working from home, I think we'll go to a model where you'll have your days in London and there'll be more like mini business trips. Those are the days where you see the people you need to see, you see your brokers and your key clients, and the days where you work from home are more for report writing, admin, and other analytical work. So I think that's where we'll move towards. I do think it gave our industry a bit of a kick for some technological process. As one of the criticisms of Lloyds is we do love our bits of paper. So it did move us forward quicker than perhaps we would have done without it. So a bit of improvement, a bit of a silver lining from the great cloud that was COVID, that everybody can get on a Zoom call now, everybody can electronically trade if need be, and then we're much more robust if we have to go through one of these ever again.
Couldn't agree more. I think that's true, and it's a change out of necessity in many cases for all of us. So I'll do my second wrap up now, because I've had a very kind 5-minute warning from Mark Rector of Lloyds America, and I'll just take the opportunity to say, firstly, thank you to Lloyds for giving us this platform to talk about the construction and engineering specialty class, and then once again to thank our panelists, Anna Woolley of Axis, John Shaw of Canopius, and Raj Brar of Axis. Thank you all very much indeed for your time and your comments on the topics today. I'm sure that the folks watching found it very insightful and helpful. And I'll leave it there. Mark, would you like to do any rounding off, and I'll be quiet?
Sure, Steve. Well, yeah, thank you all again very much. Anna, Raj, John, and Steve, thank you for taking the time. This was a great panel. It was a great way for us to round out this series for the year. And to all of you who are watching, thank you for being here. And we look forward to seeing all of you on Tuesdays in 2021. And we wish everybody all the best for the new year. So cheers.